Welcome to Envision More. Here, we dig deep into the insights of first-generation wealth builders, unearthing stories of passion, resilience, and relentless vision. Your host is Wayne Wagner Jr., founder of Vizionary Wealth Management. So sit back and dig in. It's time to envision more.
Hey, this is Wayne Wagner with another episode of the Envision More podcast. Thanks so much for joining us. Today, I'm joined by Rodney Lambert, and Rodney is a CPA and continues to do work for Vizionary with my personal planning CPA for probably 15 years or more. Rod and I have got a long history. We share a lot of clients and a lot of mutual respect. And we're going to talk. One of the most high octane conversations and topics we can possibly talk about today: taxes. Right, the one surety, the two. What is it? The two sureties in life: death and taxes.
That's right.
So Today we're going to talk taxes. So, Rod, thanks so much for joining us.
Yeah, my pleasure. I'm glad to be here. Thanks for inviting me.
Yeah, it's going to be a good conversation, and we'll get into some details and some war stories and probably a couple horror stories today. But I wanted to ask you on your about your background, because I don't know that I've ever, I know a little bit of your backstory, but like how did you end up here running a tax practice?
So I started out as a CPA in Philadelphia. So I started out working for a firm. And it was kind of old school. It was really a tough place to work. We worked 7 days a week during tax season. So I tell people that it was like an accounting boot camp, working in the city and working those hours. I mean, it was really tough. But I really learned a lot. It was a great opportunity. I was very challenged. Like I said, it was tough working all the hours, but I felt like I got about 10 years of experience compressed into just 2 years. And all I could take was 2 years. I couldn't take it anymore. So then I left for private industry, and I got a great opportunity working for Nuclear Electric Insurance Limited. So this is a multi-billion-dollar company that insures nuclear power plants, not just in the U.S. but all over the world. And at the time I was there, they insured every single nuclear power plant in the United States, and then some overseas. So I started there as the accounting manager, and then I got promoted to controller. So once I was elevated controller, it was a lot of responsibility. But the thing is, when I got that promotion, I was only 28 years old. So imagine that, like being 28. I was the youngest person in my department, and I'm running the show and in charge of all the financial reporting and compliance. And insurance, you probably know this is one of the most regulated industries that we have, like banking insurance. So we were constantly under audit. We had insurance auditors. We had our Deloitte was our financial auditor. Of course, we had IRS audits and NEIC and our local insurance department. So so it was a really, really challenging environment. We got a ton of work done. Just a small department. But after 10 years as a controller, then, I really wanted to spend more time with my family and less travel. So I landed a job at Woodlawn. So Woodlawn is a philanthropic organization that their primary mission is affordable housing and also open space preservation. So it was really neat to go from a powered corporate environment to something that was much more laid back and more, about the community, right? Because it was really important. Right. So, and a long legacy too, over 100 years of a legacy. The founder was William Bancroft, the Bancroft Mills. So it was really a really interesting change for me. I felt like I was going 110 miles an hour, and then I became got the job working in a nonprofit. So I started there as the controller, CFO, and then I got elevated to CEO, which is a big step up for me. And I really enjoyed that job. I was the CEO for 10 years, and we just did some amazing work there. I'll just highlight a couple projects that we worked on. One of the biggest ones was the national park. So we provided 1,100 acres for the national park. And Delaware was the only state in the country that did not have a national park. So even the territory of Guam had a national park. I mean, nothing against Guam,
Right.
but it's pretty far away. But we thought it was really important to make this happen, and we did everything we could to bring a national park to Delaware. And so now it's official. It's a national park, 1,100 acres, and it's the most valuable land in our area along the Brandywine. So it's really a great open space for public enjoyment, and also a lot of trails. I mean, it's an amazing property. So that was a big legacy project. And the other thing I worked on was the Flats redevelopment project, which is part of our affordable housing mission. And that was to redevelop 450 affordable housing units on the west side of Wilmington. And that's along Union Street. And so that was a really important job for me as well, is to get that started. And that was it was over 100 years old, and it's important to the city. It was the largest redevelopment project of its kind in the city at the time. So, yes, those are the two big projects I worked on. And then
I remember talking with you about those projects while they were ongoing, and it was you were working. I think it was with the Obama administration at the time on the National Park project.
Yeah, through the Antiquities Act, they were able to make the national park and make it official, right? So they were able to do that without having to go through Congress, and it was signed by President Obama. So it was pretty cool. So after I did that for 10 years, working as the CEO, I felt it was time to really take a seat back and get, I wanted to do something, just to help with, and using my background as a CPA and help clients. And I had been doing it sort of as a part-time, just kind of helping friends and family with their taxes. So I decided to do it.
Yeah, I was a client.
Yeah, you were a client, right? Correct. Yeah. And then I made my full-time venture, and then I expanded it. We have a team of 5 people, and we all work remotely, so it's virtual. We have myself. We have my brother's a CPA. He works during tax season, and then we have a full-time payroll coordinator, and then we have a bookkeeper as well, and then an office manager. So we're a boutique firm, and we really cater to, just high wealth individuals and small businesses. And we're not really looking to grow a whole lot. We're very selective about who we take on as clients. But we don't get too big. We don't want to be a mill where we're just cranking out tax returns. We want to be able to service our clients and do a really good job of doing that.
Yeah, and it's something we have on our list to talk about. But most of the time people think about taxes between about January 20th and April 15th, and they're thinking tax prep. You and I both know that tax planning happens in the calendar year that the taxes are being incurred, not after the fact. Between January
that's true.
20th
Sometimes you can do it after the fact, but most of the time you want to be proactive and take care of it before the end of the year. So absolutely, I agree with that 100%.
Yeah. I think the easiest explanation I always have is, there's a reason you see general contractors and people in the construction trades driving brand new trucks in January. It's because they got to the end of the year, they called their CPA, said, this is how much money I made. And the CPA said, you need to spend money now. But I don't have any money. Go buy a truck, something over 6,000 pounds, something you can pay for over the next 5 years. But you can get the money off the books through depreciation right now. So
we have some contractor clients that they were just in disbelief that they could actually do that, because prior to this year the bonus depreciation was 100%, and you're right. The key threshold is the 6,000 pounds, and so you're right. You don't even have to put really any money down. You can take out a loan, and the full amount of the thing is a write-off. So we've had a lot of clients that have taken advantage of that. And the bonus depreciation, it is scaling down. So this year it's 80%. Next year it'll be 60%. So that is, or actually 2023 was 80%. This year is 60%. So it is getting phased out slowly over time. But that's definitely one of the planning tools especially for contractors, anybody in the trades. They're,
Yeah.
they love to buy trucks, so see that all the time.
Anybody that needs a 6,000 plus pound vehicle, although today the electric vehicles, a lot of the electric vehicles weigh over 6,000 pounds because of the batteries.
Yeah, pretty much
So
all of them, I think. Yeah, you're right. Yeah,
yeah,
yeah.
yeah. So that's been we actually May drives an electric vehicle now, and that's what we did at the end of last year. So
Yeah, yeah, makes
uh,
sense. We do it. We see it a lot. We do it a ton with our clients at the bonus depreciation.
yeah,
So, yeah,
yeah.
absolutely. Yeah,
That was last year I looked at it and it was if we buy the car through an equipment leasing business, we can depreciate the vehicle, and we put solar panels on the property that where she does most of her charging. So I even saved on the electricity costs, and
yeah,
I get the accelerated depreciation on the solar panels.
yeah.
So
And a pro tip on the EV credits too. Like there is an income threshold, but
yeah,
if you lease the car, then
yep,
the credit is built into the price of the lease. So it doesn't matter
okay,
what your income is. The credit goes to the manufacturer. So if
okay,
your income's too high and you want to take advantage of the EV credit, one way to do it
okay,
is through a lease, which not a lot of people know.
okay. No, that's a good hack. So what you're saying is if you're you're thinking about buying an electric car for your business, but you make too much money to qualify for the tax credit, lease the vehicle instead of buy it, and they will build the tax credit into the cost of the lease. So you'll essentially get it. You'll just get it in a lower lease payment.
Correct. And if you notice, you'll see the lease cost of like a Tesla is really
Yep.
attractive compared to what it would cost to buy it and finance it. So,
Right.
so take a look at that as an alternative if your income
Yeah.
is above the threshold.
Yeah. Yeah. That's good. You've also got to be careful of the mileage in the leases. I have not seen. And I haven't seen a lot of electric car lease contracts though, so I don't know if they're still stuck with the kind of 10, 12,
Yeah, they
15,000
are.
miles per year.
Yeah,
Are they? Okay.
it's
Okay.
similar type of arrangement. Yeah.
Yeah.
Right. So
Okay.
right, it would make sense if you're using it a lot, but if it's like a second car, and a lot of people when they buy an EV, it's sort of a second car. They have to have a gas engine for their like they
Yeah.
travel a lot. So for
Yeah.
most households, what I see is there's one gas and one electric, and the electric
Yeah.
car is sort of like a commuting car, kind of an extra car.
Yeah. We were gonna keep May's gas car until we realized we were gonna have to register it in Delaware, and Delaware was going to charge us 4.25% of the value to register it. So no sales tax in Delaware, but their registration on cars is exorbitant.
Yeah,
So
it's a transfer tax, so
yeah,
it
yeah,
feels like a sales tax. It really does, but
yeah,
technically
yeah,
it's considered as a transfer tax.
yeah.
So you're not even allowed to
So
write that off on your taxes either.
right. So
No.
we turned around and sold the car because I didn't want to pay it. So
Yeah, yeah.
anyway, no, good. So you've got and you said your ideal clients are kind of high net worth individuals and families with a little bit of complexity,
Correct.
that need some assistance and support. Probably some planning through the year in addition to just kind of tax prep at the beginning of the year, right?
Yeah, when we take on clients, it's really a holistic approach, and they have me as their CPA year round. So you're right.
Yeah,
We typically don't just do a tax return and that's it, and we'll see next year. We do get a lot of interaction throughout the year, and we do prepare tax planning, and we do
yeah,
what we call pro formas, where we take a look at their tax situation, usually in the fall, and just to see
yeah,
where they're at to make sure there's no big surprise at tax time. And so we might have
yeah,
to adjust their estimates or maybe have to pay in more. So just yeah, so we like to do that. That's the typical client that we have, and
yeah,
that's what we prefer is to have a year long relationship, not just once a year.
yeah. And you and I have worked together for a very long time now, and where I think it's been really helpful and beneficial for our clients is that we live in a day and age where financial planning firms are kind of trying to bring tax preparation in-house, and there's CPA firms who are trying to do wealth management and financial planning. For most of our clients, they really prefer to have kind of a dotted line down the middle between the two of us, so that kind of the tax tail isn't wagging the investment dog or vice versa, right? So our shared clients get the benefit of my brains and my team's brains on the financial planning and wealth management side, and then your brains on the CPA side. And so we're both, experts in what we do, but we bring those superpowers both to bear on each individual client situation. And most of the time we align, but there's been times where you said, hey, you probably, can't do it this way, or you're involved in a situation. And I know that it's probably a good transition point. There's been a number of situations where I've called you and asked you a question about something, and you said, yeah, this can be done, and this can be done, and this can be done. And I remember one was a situation where I was having a conversation with a client about a horse, and that was the client. Their child was, involved in equestrian activities, and they were telling me what they were spending on this horse and the care and upkeep and maintenance and all this stuff, and I'm like, holy crap! And none of this is deductible. Like, wait a minute. And I just started asking a couple of questions. Does she have Facebook? Is there opportunity to make money through social media? Is there the events that she enters? Is there a cost to that? Is there ability to win prize money? And then we called you and said, hey, Rodney, can this be a business? And you were like, yeah, and horses depreciate really fast.
Yeah. Well, in that case too, there was a profit motive. They were making money
Right.
in eventing. So you have to establish a profit motive. It can't just be a hobby that you can just write things off. But in that case,
right.
There was definitely a profit motive, and they were making money through eventing. So there's a lot of complex situations like that where there might be an ability to take deductions. And back to your point about separating the financial advisory from the accounting and tax. I really feel like when you look at other professions like law and medicine, like everybody's a specialist, and I think the same is true for finance too. Like it's just extremely difficult, I would think, to try to manage both doing investing and doing accounting tax. There's just so much that changes, and there's so much to keep on top of that I can't imagine trying to do both, especially as a small practice. I can see maybe a larger practice, but when you're a boutique firm like ours, we just made the decision to stay in our lane and just stick to accounting and tax.
Yeah. Well, and I think that for our ideal clients, and I think for both of us, our ideal clients are folks who have maybe a few $1 million up to 20 or $30 million, but not regularly $300 or $400 million. Right, a $300 or $400 million family or household probably has either a family office that has accounting on staff, or they're working with a boutique firm with a legal tax firm, tax strategy firm, or something like that. But I think for our ideal clients, they don't want to be paying, it's not dissimilar. I guess about a year and a half ago, I had a conversation with a Goldman Sachs advisor who was trying to woo away one of our important clients. And he looked at how we were structured, and he said, I don't understand how you can do what you're doing for the fee that you're charging, because you're not charging enough. And I said, well, I don't have to pay Goldman Sachs bonuses for one, right?
I can imagine there's a lot of overhead at Goldman Sachs, yeah.
I think for our ideal clients, cost of overhead. You mentioned, you've got 5 people and they're all remote, so you're not paying a big fee. You don't have big systemic recurring fees in terms of renting office space and marketing and advertising, departments and all the other things that go into it. And so and when clients hire you, they get Rodney. They're not getting the 23-year-old Rodney who's still really wet behind the ears and doesn't know the answers.
That's right. So, yeah, that's the way we like it, you're right. We do keep our costs down because we don't have a lot of overhead as far as office space and all that. But I can tell you that there is a lot of costs that we spend on technology and keeping our data safe and using the most robust systems. And we have so many things that we employ to safeguard our clients' tax information.
Yeah.
Your head.
No, we're shooting this episode towards the end of July, just a week after CrowdStrike. So that Rodney's bringing that up in part because it's a near and present danger for all of us.
Yeah, right. So even though we try to keep our overhead at a minimum, I mean, we have been seeing an increasing cost with technology, so for sure.
Yeah,
which is extremely.
I just had my a conversation yesterday with my professional insurance guy, and he's asking me about our cyber security coverage, which everybody is. The CrowdStrike, this is kind of a little bit off topic, but the CrowdStrike event from last week is going to be a multi-billion dollar covered insurance claim. Won't cover all the damages that were done, but there's going to be billions of dollars that insurance companies pay out. So insurance companies are having to rethink on the fly what their pricing is, because they've been thinking about cyber in terms of a malicious threat. They weren't thinking about a bad update. And so that some of that hasn't really priced into the current premium structure. So he's expecting a kind of they call it a hardening of premiums, basically where insurance companies raise premiums faster on some of that stuff.
Market, right? Exactly. Yeah.
Yeah.
And the other revelation too is that I don't think anybody realized the size of CrowdStrike and how the tentacles, like how many businesses were affected. I couldn't believe the breadth of companies all over the world that they couldn't operate for that short amount of time.
Yeah.
So they're too big to fail, right? They have to be at this point.
Yeah.
So it's kind of interesting.
I was standing in a bank branch where the ATM didn't work. They could not open accounts. They couldn't print debit cards, and every staff member was completely freaked out and busy. There was a line out the door, and I joked with a couple of customers. I said, if you're ever going to rob a bank, today's the day, because none of the employees are going to get in your way. They're just going to go, screw it, take it, I don't care. So,
that's funny. Yeah. So that was very interesting what happened with that. So,
yeah, indeed. So, I mean, you and I have got a couple of other stories in terms of situations where you've stepped in. I know that it's become almost par for the course for us when we have a client who goes out of the country for a couple of years on a secondment to have you, because what typically will happen for an executive is they leave the U.S., go out of the country for a developmental role for 2, 3, 4 years on a secondment, and then they come back. While they're on that secondment, the company is typically paying a big four firm to do their taxes for them. And then they come back, and I know that it's almost become commonplace for us to say, hey, Rodney, we want to take those last 3 or 4 years of returns and have you review them, because we've had situations where you found, well, this wasn't properly captured, or that wasn't properly characterized, or this, you get a credit for the taxes you paid to a foreign entity, and that wasn't taken on the U.S. return. And so we've had a number of situations where you've been able to kind of claw back through a refiling of taxes, and that's been an area of enormous added value to our clients. So.
We have a lot of experience working with expats, and the reason that they use those big four firms is. What they typically do for the client is that it's called an equalization calculation, and when they work overseas, usually the tax rates are much higher than the U.S. So they have to basically figure out how to make them whole, and so that's what the big four firms do, and they use the tax return as kind of a tool to do that. So it is important to have the big four to do all that work. But you're right. Once they come back to the U.S., then they're no longer beholden to the big four firm, and then they utilize us usually, and we're cheaper than obviously the big four firms too. So
right.
But
because you don't have to pay was it PYC or EYC bonuses either. So
that's right. But and the big four, they're really great at working for Fortune 500 companies doing audits, but I really feel like doing individual tax returns is not really their bailiwick.
Right.
So I feel like it's a much better fit when they come back to the U.S. and we can handle their taxes going forward. So, and the other thing to point out too, if anybody that does kind of do this type of work, we work overseas. There's a lot of financial reporting on the FATCA, and so it's really important to have a CPA that knows what they're doing, because the penalties are really significant. And if you do it willfully, if you don't file these things, these reports, they're not really that hard to prepare. But if you don't do it, there's even possible jail time too, right? If you're doing it on purpose. So, so it's really important to make sure that you have a qualified CPA that understands all the concepts overseas. It can get really complicated.
Yeah. Yeah. And I mean, you point out something with regard to the big four firms where ultimately the company is the client. Your client, my client, the individual executive is not paying them, and they're not the client. And so there's not a it's much more of a tax reporting, and like you said, the company's trying to figure out how do we equalize for the tax liability. And so there's some other work that's kind of integrated with human resources and payroll that needs to be done, but that's all secondary to the actual tax prep and
Well, you're right.
and making
They're
sure
not
that the
actually
clients.
choosing. They're not choosing these big four firms. They're being chosen for them by the
Yeah,
company they work for. So you're right, and it's part of the
yeah,
deal, right? So they probably do the audit, and so they this is part of the package. If you're a high level executive, or if you're doing work overseas, then you just use the firm that they use for their audit. So you're right. They don't really have an opportunity
yeah,
to choose who
right,
they want to use. Yeah, that's true.
yeah.
Um,
No, it's
Yeah, so
been
we see that a lot. We definitely see that a lot. Every year we pick up clients that have come back to the U.S. After
right.
their assignment.
Yeah. Um, I'll kick it to you. Do you have any war stories or horror stories, or regular kind of missed opportunities that you see people make that you'd advise our listeners here to kind of be thinking about between now and year end?
A couple of things. One of the things I was going to point out is I get a lot of questions about it's called the 2 out of the 5 year rule. It's when you sell your
Mm,
principal residence. So it's a
yeah.
huge tax break for homeowners. And I think people know about it somewhat, but you can exclude up to $500,000 of capital gains if you're married, as long as you've lived in your house for 2 out of the last 5 years. And
Right.
there's just a lot of confusion. People think you have to roll the gain into another house, or you have to be 65 years or older to get this benefit.
Right.
So I'm
Yeah.
amazed at how many people don't really understand it. I think they get it confused with like kind exchanges under Section 1031. It's nothing to do with that. That's
Yeah.
business properties. Um,
Right.
but one of the things that I see sometimes, it's a missed opportunity, is a lot of times people will move out of their house, they buy a new house, and instead of selling it right away, maybe the market's not quite right, it kind of sits, or they decide to
Yeah.
rent it. As soon as you move out, there's a 3 year window that you have to sell it to be able to
Right.
take advantage of this capital gain exclusion. And so the clock starts ticking as soon as you move out, and people kind of
Yeah.
lose sight of it, and they kind of forget about it. And to me, it's like, maybe the renting makes sense, and if you're going to do it long term, like you're never going to sell the house, that's fine. But if this is just a temporary thing, it's probably better just not to rent it for more than 3 years and take advantage
Hmm.
of the capital gain exclusion if you have a large gain on the sale of the house, which a lot of
Right.
people do. And
Yeah.
it's still a pretty sizable number, right? Even with inflation, it's still a meaningful number, right? $500,000, $500,000. So
Yeah.
yeah, so I think
Yeah.
it's an opportunity that you just really don't want to lose sight of, because it's
Yeah.
extremely important.
Well, and I think you're right on point there, Rod. Because I mean, like in California, capital gains taxes at the state level can be run as high as 13.3%. So now you're
Correct.
talking
Yeah.
about 20% long term gains at the federal level, plus up to 13% at the state level. You're talking about a third on up to $500,000, which is $160,000 in taxes.
Yeah,
So
and I don't think
that's
renting it, for 4 or 5 years is. I don't know if you're gonna. I don't know if it
right,
makes sense to do that if you're gonna lose that opportunity. So, but
right,
again,
right.
but if it's a long term thing, you want to rent. You're like, this is going to be a long term rental. We're never going to sell it. Then
Yeah,
that's a different situation. But I do
yeah.
think it's something I've seen with clients where they miss the opportunity, and I just think it's a shame. So, um,
Well, and I'll go back to our contractor friends again, right? So, I mean, sometimes you'll see a contractor who always see sometimes they move a lot. They change houses a lot, or what seems to be a lot, and then their house always seems to be under construction. Well, I know contractors who will move into a house and fix the house up. So they'll move into a fixer upper, and they'll fix the house up for a couple of years, so they get the 2 years in it, and then they'll sell it, realize the gain
yeah,
with no profit, with no cap gains, and then move to another place and do the same thing. And it's just a second income for them, and with constant
yes.
avoidance of the capital gain liability.
Yeah, so we see that too with flippers. So if you live there for at
Yeah.
least 2 years, then it's your principal residence. You can do this every 2 years. So it's
Right. Yeah.
another misconception out there is people thinking it's like once in a lifetime thing. No, you can do this
Right.
every 2 years as long as you live there as your primary residence. So you're right. That's a
Yeah.
great opportunity for somebody that does flipping that's like on a small
Yeah.
scale and they have one house at a time. They can literally
Yeah.
live there and avoid capital gains tax.
The flip side is if you've got 10 rental properties, once you retire from your full-time job, you just go move into each one of the rental properties for 2 years and move every 2 years during retirement. Now, even as I say those words, I'm someone who really doesn't want to move another time ever in his life. So the
I'm with
idea
you.
of strategically planning to move every 2 or 3 years during retirement sounds like really painful to me. But
Yeah. Well,
how bad do you hate taxes?
that's back to your comment about the tax tail wagging the dog. Sometimes, even if you save money in taxes,
Right.
it may not be worth it.
That's
So,
right. Yeah. Yeah.
understood. Yeah.
Well, but there's and just thinking about that kind of a scenario, somebody who owns 10, like a husband and wife who own 10 rental properties. I mean, strategically put half the properties in each of their names, 100% in the, put five of the properties 100% in the husband's name and five of them 100% in the wife's name. And then when the first one dies, the survivor gets a step up in cost basis.
That's right. Yeah, and we see that a
Yeah.
lot too,
Yeah.
where we can avoid tax that way just by the step up. So
Yeah.
that's another tax benefit that people are not really aware of, but it's a tremendous benefit if you inherit assets that are
Yeah.
appreciated over time. And it's
Yeah.
always talked about. It's always on the
Absolutely.
chopping block for when we talk about tax reform. It seems to always
Yeah.
be discussed, but it never seems to go away. So, but
Yeah.
that's a tremendous benefit.
Yeah.
Yeah.
And we've had strategic conversations with clients where when one spouse is terminally ill, we will take all of the assets that could receive a step up in cost basis and move it into that spouse's name. Assuming it's not like a long-term care situation where they could be, where that money could get whittled away by a medical institution at the end of their life.
Right.
But if somebody,
Yeah.
you know,
Exactly. Yeah.
yeah, so somebody's on hospice, move all the assets that can get a step up in cost basis into that spouse's name so that the surviving spouse gets a step up in basis upon the first death. So, yeah.
Yeah.
Okay.
Yeah. Yeah. The other thing I was going to point out is kind of an interesting scenario that I have with a client. So it has to do with, and we have a lot of clients that utilize deferred compensation, non-qualified deferred compensation. So
Yeah.
basically, when you work for a big corporation, they allow you to defer your salary. I mean, as much as you want, pretty much. And it's not a qualified plan, so there's a lot of restrictions and limits and things like that. But as far as
Yeah.
how much you can defer, I mean, you can do a lot more than you could with a 401k. So
Yeah.
one of my clients did this early in his career, and the theory is that so when you defer, you're in a higher tax situation, and then when you retire, you'll be in a lower tax situation. Your rate will be lower when you
Yeah.
retire.
Yeah.
So that's typically the thought process behind deferred comp. And then along the way, the earnings are growing tax deferred over time. That
That's
allows
right.
it to compound faster. So
Yeah.
that's a really good strategy, and a lot of people utilize it. And it's kind of Pavlovian, right? You just kind of automatically do it because everybody says you got to do this.
Yeah.
But this client, he ended up doing exceptionally well in his corporation and moved up the ranks. And now he's retired and he's in the 37% bracket, the highest bracket. So he ended
Yeah.
up in the exact opposite position where his rates were lower when he was working. And now he's in the highest tax bracket in retirement.
Right.
And he says
Yeah.
he
Yeah.
says it's the decision he made in his career is doing this.
Yeah.
So I just want to give you the perspective on that. Like usually it works well for most people, but it's not a one size fits all situation. And in this particular case, it didn't work out too well. So
Yeah, I think there's two things pieces I would add to that, Rod. One would be frequently these plans terminate if you don't retire from the company, and so you leave the company, and then 6 to 13 months after, depending on the plan and that kind of thing, you get a check for the full balance of the plan if you didn't actually retire from the company. So that would be one thing that we've seen that has kind of cut the wrong way for clients. On the other side, typically when you're putting the money in, like, so let's say this fall I'm electing for money I'm going to put away out of next year's compensation. Then frequently they'll have well, when do you want this money back? And most people check the box at retirement, figuring that'll, it'll maybe flip over to the year after I retire. So I'll be able to spread it out over a couple of years or something. There's frequently a box that can be checked to say 10-year income stream post-retirement.
Yeah.
That's a better way to do it in my mind, because if you're going to end up building a chunk of capital to have it paid back to you over a 10-year period of time, where you may not be able to keep yourself out of the 37% bracket for some of those years, chances are you'll be able to keep yourself out of the 37% bracket on other of those years. So you're not paying the full 37% freight in 1 year at retirement.
I think that's right. I agree 100% on that. And we do see a lot of clients that are able to take it as a sort of an annuity over 10 years, like a scheduled payout.
Now, the financial advisor in me says, no, we want to control the money when you retire.
Yeah,
but
you're going to be
frankly, I've actually seen it work better for clients who take the money over time.
Yeah, and I mean, it's a good problem to have, right? You're trying to avoid the 37% bracket. But if you take it out as a lump sum, especially if you've worked there for a long period of time and you've contributed to the plan, chances are you're going to be in the top bracket. So if you can spread it out over 10 or 15 years, then you're going to be in a much better situation where you may not be in the top bracket. So, but yeah,
I had a really tough situation like that where I met a guy that did really well early on, and you're exactly right. He was putting money away when he was in a low 20s marginal bracket, and the year he retired, he was in between the 39.7 plus some Medicare stuff, plus the state. He was well over 50%. Yeah. And he was in the low 50s, and he had millions of dollars that got hit all at the same time.
Yeah, it can be a real problem.
Really painful. Yeah.
Yeah, that's why.
Yeah,
because it's kind of a stealthy. Like most people don't really think about it like that. So. But it's incredibly important to have the flexibility to take it out as a stream of income throughout your retirement, like you said, over 10 years, and then making sure that you're going to be in, if you can be in a lower bracket, that would be better, because that's a whole idea around it. So I think it is a issue, not for most people, but we see it from time to time as a problem.
Yeah. No, that's really good input and perspective. I think that we have backed off advising clients to use those plans as aggressively as we once did, in part because it used to be that you could integrate your 401k contributions, because let's say that the 401k contributions maxed out. What's the Internal Revenue Code income limit? It's 270,000, 280,000, something like that.
Something like that, yeah. 415 limits, yeah. I don't know.
Something in that range. But once you made more, once you made more than that in base and bonus, the company wasn't allowed to match those dollars into your 401k.
Correct.
But if you contributed money into the deferred comp plan, they would match those dollars. So we would try to integrate the 401k contributions and max that out on a pre-tax basis before you hit that Internal Revenue Code limit, and then start the contributions to the deferred comp plan later in the year so that you could get the matching contributions into the deferred comp plan. A lot of companies have backed off of that, and there's a big pharma company in Delaware that backed off of that a few years ago, where they just stopped matching on those those contributions to the deferred comp plan. And it was a big poke in the eye, because if you'd have somebody who was making $500,000 or $600,000, and all of a sudden they were losing a 6% match on half their income, and that was take your most highly paid competent people and poke them in the eye by losing $20,000 or $30,000 in matching contributions. It doesn't go over real well.
I can see why it doesn't go over well, and really, it's so important. I mean, we stress this with every client. Like, you want to take full advantage of the match, right? So the fact that it's out of their control, they can't do the match, because once they hit the 415 income limit, then there's no longer any contributions or nothing to match. So you're right. So that really is a difficult situation. I can see why they get really upset about that. So you're right. There is a way to do it through deferred comp to work around it. And we
Yeah.
have seen that with
Yeah.
some of our clients too.
Yeah. Well, that was the same company that they made a bunch of other changes to things like retiree medical benefits that didn't that pissed a lot of people off too. So
Sounds like DuPont. I don't.
so it wasn't DuPont. I won't name them out loud, but so it was. So well, we
Okay.
had one. They said if your date of birth is after this date, you don't get no retiree medical benefits. And I had a client that missed it
Wow.
by 7 weeks. So he'd
Wow.
been there
Yeah.
like 28 years. He worked there his whole bloody career. He was like there 28 or
Oh, that's a
29 years
shame.
or something, and then
Well,
missed the cutoff by 7 weeks. So,
but
but
even if he did miss the cutoff, I don't know that a lot of people know this, but retiree medical benefits it's not a vested benefit, so the company can change that at any time.
yep,
We've seen
yeah,
companies do that too, right? Where they provide a stipend, or they kind of minimize the benefit.
yep,
So
yeah,
even if he would have gotten in, there's no guarantee that he'd have it forever. So
yeah.
just my 2 cents on that.
Yeah, and anytime you've got a change coming, you end up with I love microeconomics. I have my son's girlfriend is taking microeconomics this next semester, and she and I were talking about the book Freakonomics and how people make, like in the micro, from their little view of the world, people make financial decisions. And so I had a client who was on the board for the company who oversaw the healthcare plan, and there were some pending changes to the healthcare plan. And he said, Wayne, we announced these changes are going to take place next year. You would not believe the number of knee replacements and hip replacements we have going on the last 6 months of this year. It's
Yeah.
like everybody who was thinking about having a knee replacement or a hip replacement in the next 10 years decided to have it in the next 6 months because it's covered this year, but it's not covered next year. And he said, we were already facing a shortfall in terms of how we're going to pay for all this stuff because it's a self-insured plan.
That's funny. But I think it was Charlie Munger that said something about like everything's tied to incentives, right? You just look for the incentive, and that's how you figure things out. So it's pretty much the same
That's
thing,
right.
you know? Yeah.
And I mean, we think about incentives in terms of salespeople, but I mean, all of us, we try to do the things that compensate us the best or compensate us the most, right? And that's
Right.
in
It's
my
human.
industry, the word fiduciary is a big word, and that's why we act as fiduciaries for our clients, because ultimately we're beholden to act in the best interest of the client, not to pursue profit, right? So,
Yeah,
but that also
that's
means
the
that I look at it and I go, hey, that also means I look at it and go, okay, we can't make any money doing taxes, and Rodney's going to do a way better job than we will anyway. So we'll refer that business to Rodney.
I appreciate that. Yeah. Yeah. Well, we always joke about fiduciary as the other F word, you know. But it's important. It's important because we really are all fiduciaries, and our clients trust us to, and that's really
Yeah.
how my practice is built is on trust,
Yeah.
because there are other firms that charge less than we do, and they're more like mills. They just bang out tax returns. But I think people really
Yeah.
appreciate that they can trust us with their tax return and all the tax planning. So yeah.
Yeah. We talked a little bit about people who are putting money away in lower income tax bracket years and then getting whacked with it on the back end through the deferred comp plan. We're coming towards the end of our time here, but historically, we're in a period of very low income tax brackets. And, now we know that that's supposed to end by the end of 2025, unless Congress and the president act. We also know that Washington is really good at doing nothing. So literally, if they do nothing, tax brackets go up in 2026. Is there anything in the next 18 months that you would say people should be maybe thinking about doing in anticipation of potentially higher income tax brackets?
Yeah, so I think you're right. I think the way to look at this is that I think there's a high likelihood that we'll see higher tax rates in the future. I just saw that the current federal budget deficit is nearing $2 trillion, and this is peacetime. It's a record. So,
Yep.
so something has to give, right? So definitely, I think you're going to see a push for higher taxes. I mean, the Republicans want to make the current tax law permanent, but I just don't know if they're going to be able to do that. So I think you're right. I think higher taxes is probably in our future. But one of the things that we work with our clients on is a Roth conversion strategy, and doing that, and most people don't realize, but it protects your savings from future tax hikes. So if you can lock it in, you have to, when you do a Roth conversion, you transfer monies from a traditional IRA to a Roth. You have to pay tax up front, but you're paying it at these lower rates, and so you're effectively locking those in, and you're protecting yourself against future tax hikes. So we do that a lot. And we typically, what we do is we make sure that, and this is part of our tax planning, we make sure that our clients stay within the 24% bracket or lower. So we never really want to do a Roth conversion if you go into the next bracket, which is 32%. And the Roth is great too, because the earnings grow tax-free. So as long as you take them out in retirement, the whole thing comes out tax-free. Another feature of the Roth that our clients love is the fact that when they die and they bequeath the funds to their children, those IRAs are free of tax, or free and clear. So there's no inheritance tax, no tax on inheritance when you inherit an IRA. So the Roth is great. It's like the best thing since sliced bread. And furthermore, you don't have to worry about having those mandatory withdrawals when you turn 73. Right. You don't have to have the RMDs. They're called RMDs, required minimum distributions. So that concept doesn't apply to Roths. So you can basically keep it in there as long as you want. So so I think the Roth conversion strategy will help buffer any kind of increase in taxes in the future. And we do them ladder too. We ladder the strategy where we do increments every year, $50 or $100,000 a year, depending on their tax situation, and making sure they don't go into an upper bracket. So that's one of the things that we're doing.
Yeah, and frequently, so we've done a lot of that planning with for our mutual clients together, and I agree. Generally trying to stay in the 24% bracket or below. Now, there's some people who say, well, you don't want to jump any tax brackets at all. But if you're in the bracket below 24, you're at 22. It's literally only a 2% higher bracket to jump into the 24.
Right. That's right.
And it gives you a lot more space. It gives you a lot more space to capture that. And I would agree that this year and next year present a clear and present opportunity for Roth conversions. And the big challenge is if you're in your late 50s and you're already in the 32, 35, 37% bracket, well, it doesn't make sense to do it now. The other thing we try to triangulate against and at least factor into the conversation is the fact that when you do a Roth conversion, when Medicare does a 2-year look back, they're going to see that big income. And if you're doing Roth conversions every year, you can run the risk of higher Medicare premiums. And we've got to take that into account.
Yeah, it depends on your age, and that's an issue. Is the Medicare surtax, and it's called IRMA. It's essentially like they charge a higher premium if your income goes up. So there's a lot of moving parts to this. And also, it could throw you into a situation where you pay the net income tax on investment income. So that's the Medicare surtax too. So if you do a Roth conversion, if you go over $250,000 in AGI, then you're subject to additional tax is 3.8% on your investment income. Right. So there are some things that we look at when we're doing this planning. It's not that's cut and dry where you just say 24%, just do it. So we do look at all those different factors when we're doing the tax planning for Roth conversions. But what we see typically is we'll see somebody that sort of retires early in their 50s, and they're doing like freelance work or consulting. So their income is not as much as it used to be. So there is some headroom where we can do the Roth conversions, and they still have plenty of time to do it before they turn in their 60s and retirements. And that's almost
counterintuitive, right? Because I'm sorry, I jumped in there. It's almost counterintuitive, right? Because so you retire and you're making a couple $100,000, you're making maybe 250,000 income, and your natural mentality is, hey, I need to set up an individual 401k. I need to set up a SEP. I need to figure out something to reduce my tax liability when, especially right now, this year and next year, the opposite strategy may actually be the better strategy to say, hey, no, you can make up to about $383,000 joint married filing jointly and stay in the 24% bracket. Your earned income is $200,000. It leaves you $180,000 worth of Roth conversion room. So we actually want to increase your tax liability this year and not take all the deductions we can, because we have an opportunity to ransom that IRA money into a Roth and get tax deferred growth and tax-free withdrawals forever on it.
Correct. Yeah.
So
yeah. It's actually tax-free growth too, right? Because you'll never pay tax on the earnings. Yeah. So yeah, I totally agree with that strategy. We do it all the time. It's very popular. So that's what I'm doing in the fall. I'm doing Roth conversion strategies for my clients. Yeah.
Right. That's why we're filming this in July, Rod.
That's right. Yeah. Good stuff.
It's we'll put this out in the fall, right around the time that clients need to be thinking about this. That's why we're doing it this way, right? So now this is really beneficial. I think you've thrown a bunch of tax hacks at us today, Rod. I really appreciate your time. And any other major topics you want to make sure we cover today, or about time to wrap this up? What do you think?
I think we covered a lot of ground today. So I'm good. So I really appreciate this opportunity to talk about taxes. I know it's not a fun subject for a lot of people, but I do have a lot of clients that get excited about saving tax. So you can look at it two different ways, right? So, but thank you so much.
What is it? And it's tax management, not tax avoidance. One of them ends you in jail. This one does not.
That's right. Yeah, avoidance is criminal, right? So you don't want to do that.
Right. That's right. We're not avoiding taxes. We're managing taxes.
Correct. So, that's right. Yeah.
Good stuff. Well, Rod Lambert, thanks so much. We'll make sure we put your contact information in the notes on this episode. But thanks so much for committing some time today, and I think you gave us a lot of tax hacks to be thinking about in the back half of 2024. Thanks again.
Yeah, my pleasure. Again, thanks for the opportunity, and I look forward to doing it again sometime.
Thank you for listening to the Envision More podcast with Wayne Wagner Jr. of Vizionary Wealth Management. We hope you were encouraged and inspired by the conversation today. If you want to dig deeper into the show notes or Wayne's work at Vizionary, you can find us at envisionmore.com. That's Envision with a Z. Advisory services are provided through Wealth Plan Investment Management. Wealth Plan Investment Management and Vizionary Wealth Management are separate entities. The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Thanks for listening.